Investing. It's one of those words that can feel intimidating, like something only Wall Street professionals or millionaires do. But here's the truth. You don't need a finance degree or a fortune to start investing. In fact, the earlier you begin, even with small amounts, the more powerful your money becomes. In this video, we're going to break down a simple, beginner-friendly guide to investing in stocks and ETFs. By the end, you'll know exactly what they are, how they work, and how to get started without feeling overwhelmed. So let's begin. Part 1. Why invest at all? Imagine you save $100 every month and put in a savings account. After 1 year, you have $1,200. Not bad, but with today's inflation, that money actually buys less over time. Now, imagine you put that same $100 each month into investments that earn an average return of 7% per year. After 1 year, it's a little more than $1,200. But here's the magic. Keep doing that for 20 years, and it grows to over $50,000. Keep going for 30 years, and it's over $120,000. That's the power of compounding. Your money isn't just sitting there, it's working for you. That's why investing is essential if you want long-term financial freedom. Part 2, what are stocks? A stock is simply a piece of ownership in a company. When you buy one share of Apple, Tesla, or Coca-Cola, you literally own a tiny slice of that business. If the company grows and becomes more valuable, so does your stock. If it pays dividends, you earn a share of the profits. But of course, if the company struggles, the value of your stock can go down. Stocks are powerful because they can deliver high returns, but they're also riskier since individual companies can fail. Part 3. What are ETFs? ETFs, or exchange-traded funds, are like a basket of stocks. Instead of betting on one single company, an ETF lets you invest in hundreds or even thousands of them at once. For example, an S&P 500 ETF holds shares of the 500 largest companies in the US. Companies like Amazon, Microsoft, and Google, all bundled into one fund. When you buy one share of that ETF, you instantly own a piece of all 500 companies. The benefit? Instant diversification. Even if one company in the fund does poorly, others can balance it out. That makes ETFs safer and easier for beginners compared to picking individual stocks. Part 4. Stocks versus ETFs. So, which is better? Stocks give you the chance for higher returns if you pick winners, but they come with higher risk. ETFs give you broad exposure with less risk, but usually with steadier, average returns. For most beginners, ETFs are a fantastic starting point because they take the pressure off having to pick the right company. Think of it this way. Buying individual stocks is like betting on one player in a game. Buying an ETF is like betting on an entire team. Part 5. How to get started. Step 1 is choosing a brokerage account. Today, there are dozens of apps and platforms like Robinhood, Fidelity, Vanguard, or Charles Schwab that let you start with as little as $1. Step 2 is deciding how much to invest. You don't need a lot. Even $20 or $50 a month makes a difference over time. The key is consistency. Step 3 is choosing what to buy. For beginners, a simple ETF like S&P 500 ETF, VOO, or SPY. For US large companies. Total Stock Market ETF, VTI, for the entire US market. International ETF, VXUS, to diversify globally. Stick to broad market ETFs, and you're already ahead of most people try to pick stocks. Part 6. Common mistakes to avoid. Now, let's talk about what not to do. Don't try to time the market. Nobody can predict when stocks will rise or fall. Instead, invest regularly, known as dollar cost averaging. Don't panic when prices drop. Markets go up and down. What matters is the long-term trend, which has always gone upward. Don't invest money you need soon. Stocks are for long-term goals, at least 5 years or more. Don't forget about fees. High-fee funds eat into your returns. ETFs usually have very low fees, which is why they're so beginner-friendly. Part 7. Building a simple beginner portfolio. If you're completely new, here's a simple strategy that works for most people. Put 80 to 90% of your investments into a broad ETF like VTI or VO. Put 10 to 20% into an international ETF for global exposure. If you want to learn and experiment, use a small portion, maybe 5%, to buy individual stocks of companies you believe in. This way, your money is diversified and safe, but you still get to learn and have fun watching companies you like. Part 8. The mindset of a long-term investor. The most important part of investing isn't the money, it's the mindset. When you invest, think long-term. You're planting seeds that may take years to grow. Checking your account every day will only make you anxious. Instead, focus on building the habit of investing regularly and letting time do the heavy lifting. Warren Buffett, one of the world's greatest investors, once said, "The stock market is designed to transfer money from the impatient to the patient." If you remember nothing else from this video, remember that. Final thoughts. So let's recap. Stocks are ownership in individual companies. ETFs are baskets of many stocks, making them safer for beginners. Start with a brokerage account. Invest regularly. Avoid common mistakes and focus on the long term. You don't need a lot of money to begin. What matters is consistency, patience, and staying invested. If you found this beginner's guide helpful, hit the like button and subscribe for more simple investing tips. And let me know in the comments, are you more interested in starting with stocks or ETFs?